Welcome, everybody, to another week of Wealth Wisdom, where we're helping you build wealth and legacy.
Companies are like an organism trying to survive.
It's always a risk when you're investing in a company that's purely tied to someone's brand.
45% of Americans have gone into debt for a Disney trip. All right, welcome back to Wealth Wisdom, the podcast that helps you build, protect, and enjoy your wealth with confidence. Today, we're diving into a topic that's central to how we invest and how we guide our clients, why we believe in going all in on equities. I know that sounds aggressive. Isn't that risky? What about bonds, gold, alternatives, real estate? Don't you need to play it safe as you get older? We'll break all that down today, looking at the date, the misconceptions, the mindset required to embrace this approach. Because you understand what equities really offer in the long term, and it's just navigating the short-term noise. Just without further ado, let's jump into it, guys. Can we, start with you, Bill. Where did the strategy come from? Why are we so long-term bullish on equities? And is there any clarification there?
I mean, for a number of reasons, but my biggest thing is that it's when you look at all the ways to, like you were just saying, make money
what
off
about
your
bonds?
money and compound. You know what I mean? Compound things. It's great to. I don't know why I'm having such a difficult time with this, because it's a very easy concept in my mind, but inflation is a massive, massive risk that people do not see. Right? Everyone thinks that losing money.
Huge.
Inflation is the same thing as losing money. You're losing the purchasing power. And what's the number one way to combat inflation is by investing in the equity markets, right? So that's the biggest thing, is that the stock market allows you to gain a return that outpaces inflation, giving you a real return on your money. Yeah. And by not having that as part of your portfolio, your purchasing power is going to be decimated over time. And that's why it's so important to be in it. There is volatility. Those are things, but these are all things that we know, right, are going to happen, or we should expect, I should say, whenever doing any type of equity investing. We should expect these downturns, almost embrace them in a sense, right? And but we'll know that we're going to come back stronger. We're going to get back up to par for where we were, after these downturns, and get making money again. And over the long term, right, you're going to see a good return on your money, right? From 1926 to 2023, just U.S. large caps, right? So if you looked at like the S&P 500, the Dow Jones, just industrial average, things like that, I mean, you're looking at a return of 10%, right? An average annual return of 10% on your money. Yep. That means your money is going to be doubling a little over every 7 years. Right? So if you put money in the market and you're getting a 10% rate of return, in 7 years, that $10,000 investment is going to go to 20, right? In another 14 years, that 20,000 is going to go to 40. Another, 21 years down the line, that 40 is going to go to 80, right? So it's so important to have a long-term outlook. And if you have, most people do, you're investing 4, 5, 7 years down the road, right? You know what I mean? You're investing in equities. For more of the short term, right? That's where you're using your money markets, maybe a bond ladder, you know what I mean? Things like that. But you're really investing for the long term. So if something happens where we do have a downturn and it does last 7 months, 6 months, 13 months, right? Which I believe is the average. Justin or Eric, you can fact check me on that. But if that does happen, well, guess what? You're investing for 3, 5, 7, 8, 10, 20 years down the line. So it really shouldn't bother you. In the moment it does, but the long-term rewards far outweigh the risks that you face by not having them in your portfolio.
Eric, what would you, what are your thoughts there?
I don't know. I think that was very well done. I think you could add in that the financial plan is kind of what determines this. Like for some people, for some clients, they're in all equities. They're like, hey, I'm not going to need this money for 10, 20 years.
Yeah.
Let's beat inflation. Let's grow it. Some clients, oh, I might need money for a house a couple of years. I've got this wedding expense coming up. I've got this. We have that on the side, treasury bonds, money market. We're trying to at least match or beat inflation by a little bit. So a lot of it's financial planning can help you figure out exactly how to invest. A thing that happens in our industry is advisors tend to focus too much on risk tolerance, and they actually train clients to be more conservative to a point where it's detrimental to their own growth and their financial plan.
They're more worried about pacifying their clients, right? Things like that.
Exactly.
Or losing their clients, right? Because there's some volatility. Not necessarily doing what's in their long-term best interests.
Correct. Mm-hmm. Correct. Yeah, because a financial advisor knows that if they have a portfolio that's less volatile, they're more likely to keep that client, even though they're sacrificing that client's long-term growth. So you really want an advisor that's going to manage to your financial plan, not cater to fears, which are very valid, but a financial advisor can kind of help take that out of the equation and really focus on the long-term growth. Yeah, I don't know if I just rambled too much, but
yeah, well, I would say most people's risks are running either not having enough or running out of money, right? That's like you know biggest risk.
Right.
Not necessarily like being safe. Like that's more of people's things. So you want to make sure that you're in something that is going to maximize your earnings as much as possible, compound that as much as possible. So that way all those rising costs, all those things that come up, healthcare, food, utilities, things like that, you want to make sure that you're beating that, right? Your investments are beating, you know what I mean, the pace of those. And that way allowing you to not worry about money down the line, right? That's the thing. So you want to make sure that balance is there. You want to be able to sleep at night, but that's why you want to have a coach, an advisor in your corner who's making sure, not pacifying you. That's a big thing. You don't want someone who's going to pacify you. They want to have someone who has, strict ideals and coaches you to be in the right direction. When those times are really bad, and everything looks like you're in, this dire state, you want that someone who's going to have diamond hands, right? So to speak.
Yeah,
all right, we're
follow
doing
the plan.
everything. Exactly. We're following the plan. Everything that we plan for, that we're looking at, right? That is all still there, but we need to follow the plan. If we deviate from that plan right now, that is going to throw off those future plans, right? So it's very important because I don't know how many times people have called when things are looking bad, right? And they think the world's going to end. What if I lose everything? What if this never comes back? What if things like that.
Well, that's that's what the media does.
Example. We have a
Yeah,
very
we do.
recent example. Yeah. Trump, Liberation Day, markets were down like 20% from the top there, and took about 2 months for it to rally all the way back. I'm sure there were people that sold at the bottom there and panicked. Yeah,
And there's people who are afraid to buy at the bottom.
True, yeah. I think some fears are valid.
Yeah, I mean, buying on the dip, I feel like that's like a whole nother discussion, but more like when you're invested and when you're thinking, taking a long-term approach, when stuff like that happens, you just want to make sure that you have someone who's going to be able to coach you properly through the risks of where you're at, where you're going, and if you deviate from that plan, from what was set in motion, again, knowing that these things were going to happen.
Yeah.
Right. When we do a financial plan for someone, we have these things in place knowing that there's going to be recessions, right? These are planned for events. We don't know when, we don't know how long. We know that they're going to happen, right? Historically, they have, they've happened time and time and time again. In the future, they will happen time and time and time again. But you want to make sure that your financial plan is in place. Do not deviate from that plan. Make sure that your equity allocation is in a place that, can withstand and grow over time. It's so important.
So what's the I mean, just to be, we the intro was, hey, we believe 100% equities all the time. And to clarify, I think what you're really saying is it's dependent upon the person's goals, their unique goals, their situation of life, how old they are, when they'll need certain periods, sums of money. Just because, and that's what I think, working with you guys, knowing the inside scoop, I think you guys handle every client differently and uniquely and help them with their goals. How do you, I guess, Eric, do if someone's 80, are they still all in equities? Or is it not just black and white?
Not if they're currently withdrawing from their portfolio.
Yeah.
They'll still have a decent portion in equities. A lot of advisors are going to 60% bonds, 80% bonds with an older client.
Oh, wow.
A lot of our clients, though, are thinking about living another 10, 15 years, thinking about the next generation. They're like, why would I want to give up growth opportunities right now? But I don't know. I hate like beating a dead horse, but it's all about the financial plan. Like we believe in 100% equities for your long-term assets, but you need to create those buckets. You need to say these funds are for long-term growth. I'm comfortable with the ups and downs. These funds are for my withdrawal plan over the next 2 years. I want this to be very safe. So it's all about creating those buckets within a financial plan.
If you're about to buy a house.
Sure.
Okay.
Yeah, we're gonna take that out of the stock market.
So there's several buckets: long-term wealth, immediate needs, and maybe like 1 to 5 years of goals, like purchases, big things like that. And then there's probably schooling, if you have kids.
Sure.
Would that be a third bucket, maybe?
Yeah, and that's going to vary by each child, right? When's it coming up? Yeah, because you want it to be invested aggressively while your kid's young, so it can compound. But then, a few years prior to school, you want to start taking off that risk because you need that money there once they turn 18. We've seen clients, the account's grown significantly, but then right before school starts, you might have like 25% market pullback. And now that money that they thought was going to be there isn't there. So it's important to start taking off risk as they're getting to college age.
That's such an important point.
Yeah, it's planning your investments to cash flow. That's, you know what I mean? That's the number one thing. It's planning your investments to your cash flow.
But so what about diversification? I mean, everyone says diversify.
Everyone thinks they're diversified, but like no one's diversified anymore, especially in all these mutual funds and ETFs. What is it? What is the stat now? The Magnificent Seven is 40% of the S&P 500. So when you're buying that, you're buying a portfolio that's almost 50% seven stocks. It's been the right thing to own though the last 10 years. But a lot of people are buying these funds thinking that they're diversified, and they're not.
I guess I'm talking about like diversification across assets, right? Like I'm just playing devil's advocate here. Shouldn't you diversify into like bonds and commodities and whatever, real estate, whatever, or are equities enough? I mean, what's like portfolio theory? Is it like that 60-40 split?
Yeah, the traditional portfolio theory is 60% stock, 40% bonds, some cash or whatever. And then but like for me personally, right? I have all my long-term investments are in stock.
Okay.
That's it. I know that that's there for the long term. I have a separate bucket on the side that is for our next home purchase, which I see coming in a couple of years. We want to upgrade. We need more space if we're going to have another kid. And then I have another small bucket that's savings. It's 3 to 6 months living expenses. That's in a savings account, just going to match inflation, right, for the most part. But but I'm not diversifying for the sake of diversifying. I'm not, because I've been told I need to have a 60-40 portfolio.
Gotcha. Yeah. Bill, do you think if you were 100% equities, can you still, I mean, are you diversified in just that, or is it, does diversification even come into play here? How do you think of it?
Yeah, across different sectors. There's different, the way certain sectors of the market operate very differently, right? A utility stock operates typically, maybe not in the last year or two, but operates very differently than a high flying tech stock or a high flying healthcare company, or, you know what I mean? Things along those lines, right? There's different sectors offers more mature companies that typically pay dividends or profits right from the business to their shareholders. That may be where you're getting the majority of your returns right from that stock, while other ones might be just in capital appreciation. So you want to make sure that you're diversified among the different sectors, and also to your investing to your needs, right? That's a big thing in terms of diversification is, well, what types of equities, right, are you invested in? Because it makes a huge difference depending on what you're looking for or what you need.
Makes sense. That makes a lot of sense. Yeah. So it's so to summarize it, it's long-term growth with equities, short-term making sure you're taking care of your immediate needs.
Yeah.
Yep.
Okay.
But I would say even with bonds and things along those nature, to have them for a long-term asset, I don't think is a good idea, because you're not going to keep up with inflation. I think you'd be better off going with some type of mature company, such as a utility company, things along those lines that pay dividends, are growing their dividends, right, as they raise REITs and things along those lines, right, on their customers, and they raise their dividend over time. That will help you, give you a cash flow, and then hopefully then you're going to get some capital appreciation as well, which in turn, for maybe a little bit more risk, is going to give you a lot more return over the long term. You will have to deal with some volatility, although companies along those lines typically are not as volatile as other areas in the market. But for a little bit more volatility, you get so much more return over the long term. And then you're not getting hit with those massive amount, you know what I mean? Inflation is going to eat away at your purchasing power if you don't keep up with it. And you want to make sure that you're keeping up with it and beating it, and allowing you to have the lifestyle, to maintain your lifestyle. That's the biggest thing. You want to have a worse lifestyle or a better lifestyle down the line.
Yeah, I mean, what you just said, that's huge. I mean, if you have your money sitting in a big bank, you're getting, nothing. On no interest, but it's like I don't even know, 0.0 something percent.
Even if you're getting 3-4%, that's not going to cut it over time.
No, but I don't know any bank at savings rate is giving you 3-4%. Maybe a high yield savings account is pulling that off, but you open up a Bank of America savings account, they're giving you maybe 1%, which
Really?
you're just drowning.
Altruist is still giving us close to 4 for our high yield savings accounts.
The big banks that are more of your operating accounts, so to speak. Yeah, they don't pay a lot of interest typically, right? They may on the CDs and things like that, they may match up, but yeah, they're not going to match up with some of the maybe online, online savings accounts and things like that.
Right.
Like you said, such as Altruist. Well, Altruist is more of a brokerage account, right, with a money market. So those types of things, right, you can, that's where you're going to get that higher
at
yield.
At least you're matching or slightly beating
you
inflation.
got Goldman Sachs, those Marcus accounts. You've got, Citi. There's all sorts of, American Express, I think, offer. There's all sorts of online accounts, money market accounts, where, again, you want to park that emergency, right? Your emergency reserve, so that 3 to 6 months, if you have it, of expenses, great place to put, to park that money. But yeah, the money for the long term, you don't want to have the savings account that's for 8 years down the road. That's not
right.
That's not what it is. You're not doing yourself any favors there, right? That's for its emergency use that could potentially be used right away. That's where you want that money in there. Everything else you want to have in equities growing for you. That's so important, right? Growing and compounding for you.
So is it safe to say, like, it's a rule of thumb, Eric, for like if you don't need the money for 10 years, should it be all in equities? Or what do you guys think? Is there
Yes.
a general rule? Yes,
All in equities if you don't need it for 10 years, easily.
easily. Okay. All right.
10 plus year horizon. You gotta.
Put it all
Yeah, think
all in
about it.
equities.
2008,
Yeah.
like one of the worst crashes in history, it was like 4 or 5 years, and the market had already recovered at that point. So,
Mm-hmm.
And that's like
you
one of
could
those
you could make
lost
the case for
decades
5
too.
years.
That
Yeah.
like 1998 to 2008 or 99 to 2009. But even with that, when you cherry pick those numbers, like 4 or 5 months later, you still had like a 30 or 40% return. Like, you know what I mean, on your
Right.
original investment. So yeah, you can look at it and say, oh, it was negative for 10 years, something like that. But then a few months down the line, you're up. So those numbers,
Yeah.
people like to scare you with the fear and things like that. But if you look not too far out of that space, you make a very good, you know what I mean. You'll have made a return, you know what I mean, on your money. So
Yeah.
don't be scared by some of those stats, because stats can always be used in a certain manner, right?
Yeah, manipulated.
Yes,
Yep.
manipulated for an argument.
Yeah.
They're not necessarily true about what went on when you look a little bit outside the box of what they're talking about. So that's important too.
That's so true. All right, so let's dive into one of our current holdings. We've got Meta. This is, everyone, I picked this one to talk about today because it is highly used. If you don't know, Meta owns Facebook, Instagram. I think there's several others that
Yeah.
what are they on? There's
Well, they
another
make the
chat
Oculus. Make the
WhatsApp.
Oculus.
one. WhatsApp. Thank you. Yeah.
Yeah.
They make Oculus and they have cutting edge AI. So when did we buy it?
In
Why?
Threads.
Why did we? What'd you say?
I said in Threads. I don't know if anyone uses Threads.
Threads. That's right. Threads.
Twitter's right. That was Twitter's competition. They were going to blow Twitter out of the water. I have no idea if they are or not. I just thought that was funny when they.
Yeah. Dude, they're pushing it hard. They've just have such distribution. I mean, it's just insanely popular, their products.
Yeah.
And all their reality labs, right? All the stuff that they're doing within the metaverse. Which in the past investors haven't been a huge fan of because they seem to just lose money.
They have not liked that.
No, I mean that was actually, it's funny that caused, or was one of the reasons why they had such a huge downturn in 22, is that they were spending all this money on
Yeah, people didn't like it at all.
and it was like, it's not producing anything, and I just don't, a lot of people were like, I just don't see this as a future, right? You know what I mean? It's probably like way beyond its time, but that definitely caused investors to kind of, as well as a few other things, right? There was a few things that Apple had done to stop kind of the potency of the ads, right? And things like that, and that caused a big issue. But, Facebook.
For privacy.
Yeah, but, they're a very innovative company. They went back, kind of retooled and things like that. And a lot of their ads came back where they were better than they were before. Right. Yeah. Very dynamic company.
Right. And I should say, just as a disclosure, this is not investment advice, and this is for education and entertainment purposes only. But when did we buy Meta? Do you guys remember what was the rationale at that time?
Do you guys remember
that?
Do we have the exact date in the notes? Because I don't
No.
know. We've owned it probably 2 years.
Okay.
But it was on its rally from its bottom when investors panicked about their spend. They're like almost like unsustainable spend on the metaverse. The stock tanked. It was rallying back. We had gotten it at that point, and their rally, like we spoke about, was.
And I want to say, when you speak about valuations and things like that are crazy, I don't know what Meta was at its lowest point. I think at one point it was trading at like 8 times earnings, which is like unheard of.
Yeah.
If you look at like today's, maybe it wasn't quite that low. Maybe it was like 12, but like just an insanely low valuation in terms of like today's, right? You know what I mean? Like if you look at stuff trading at 30, 35, 25, and even more, right? You got companies like Palantir that are trading at, I don't even know, 400 times earnings, 500, just
That's
it was
incredible.
so low, right? It was almost jumping out at the page, right? But this was, again, dire time, right? We had been raising rates constantly. There was, the markets were down. I mean, even major companies like Nvidia, that's like down 60%, 70%.
Wow.
You know what I mean? Things like that. I mean, that's quite a roller coaster.
So it's a great time, great opportunity, great company, long-term growth.
Yeah,
Right?
and I mean,
That,
I know I definitely got, speaking with some of my clients, right? Some people were like, "Oh, I never want to be invested in Facebook," right?
oh
They
wow.
feel like there's a moral and
Mm-hmm.
ethical thing there. They don't think it's like a good thing for society. I
I would
definitely
tend to agree.
it's something that needs to be limited, I think, in everybody's life. But I think there is a lot of cool stuff with, for content creators, ways to get, their business out there. Like if you're a chef, it can be a really cool thing, right? To show how you make food, and you know what I mean? Things like that. That can bring some notoriety to your restaurant, right?
Yeah.
Yeah.
If you're a comedian, if you're, in any type of art, right? Any type of the arts, it allows you to get more exposure and things like that. There's a lot of grifts. There's a lot of bad stuff that's on there that's tough to
Yeah.
navigate through, and it's definitely addictive, right? Like people like
Highly.
that dopamine hit of getting a cool video. They see it. Oh, let me see another one. Oh, let me see another one, and it can be a very, let's say, big waste of time for a lot of people.
Yeah.
They make a ton of money in advertising, you know what I mean, because it's so addictive, right?
Right. At insane margins. Absolutely. I think they make 99% of the revenue on advertising.
Yeah.
It's wild. And I also think, when it is widely used, it's addictive. So I would say for those two reasons alone, it's tough to take them down. So in the amount of data they have on people,
I'm sure.
that's why advertisers love their ad platforms. It's incredible.
Well, and it's incredibly valuable to have all that for the future of AI. You see all these companies making deals with Reddit, right? So they can have access to all the conversations that have occurred on their platform to train AI. Meta already owns all that, so they can train their AI. They don't have to worry about
deals
so
and things like that.
There's a ton of value in that data alone. So we bought it in October of 2023. It's up. I'm just looking at the cost basis lot. So it's up almost 130% from that point. And a lot of that, when you read the analyst reports, a lot of it is about the efficiency of its ads. AI has allowed them to place targeted ads that are more effective. People are more likely to click on that, purchase something. So a lot of advertisers have moved probably from Google to Meta.
Not only that, the advertising has gotten smarter, but also the content. They call it the TikTokification of content, where instead of like just getting fed interest content that your friends would post, right? So now you can sign on with 0 friends and 0 followers, following 0 people, and it'll feed you content that it knows you're interested in. So it's all
because it pulls across all your Google search.
It's also they know
all your info. Yeah.
They also know how long you linger on certain posts. So if you start lingering, you kind of engage slightly with a post that's about financial education, it'll start feeding you more of that. If you start lingering on chef and cooking or cleaning, whatever it is, it immediately, not over time, immediately will start feeding you that stuff.
Did you notice that, speaking of TikTokification, did you notice that Twitter just started kind of pushing that more?
Yeah.
I was on there and I noticed I was scrolling through videos. I was like, oh my
They're
God.
I mean, they have to. They have to compete, so that's why they shifted, and that was a dramatic shift. I would say 2 years ago. But yeah, so that's it for the show today. It was pretty quick. We want to get back, let you get back to your daily grind if you're listening. Next week we are talking about how to double your savings in 2025. Stay tuned for that. And that's a wrap.
All right. Be good, everybody.
Thanks, guys.